Urban office space developer Allied Properties cut its monthly distribution by 60% as the company looks to reduce debt. So let's get more from Brad Sturges, equity research analyst of real estate and REITs, Raymond James. Thanks for joining us today.
Great. Thanks for having me.
Was this a must-do for Allied?
Yeah, I would characterize it as we were expecting a distribution cut. Clearly, they had telegraphed this as part of their commentary on their call the last quarter. We thought the payout ratio was at a point where a distribution was unsustainable at the current level. So, given where the stock had basically traded over the last several weeks, we thought a pretty material cut was already being priced into the stock here today, and ultimately we saw a sizable cut that we thought was in general pretty prudent, and where we kind of expected the size of the cut to be, to kind of right size the payout ratio, right size the amount of cash that they're retaining to start to repay debt and improve the balance sheet.
How deeply in debt is Allied?
Right now, the key metric we typically look at is debt to EBITDA, and debt to EBITDA is at a historically high level for Allied. They're running at, call it 12.5 times on that metric. They do have a plan in place to now retain more cash through the distribution cut, but more importantly, they do have some asset sales planned over the next few quarters into 2020, mid-2026, and then they could get cash back from some of the condo closings that are expecting at King Toronto. So there is a plan in place to reduce debt levels and try and get that leverage metric down, a few turns from, call it 12.5 times to call it into the low 8s. So there's still work here to be done, but we view the distribution cut as probably the most important first step here.
How much of a dent will this make to their debt?
Ultimately, it's more of a modest impact. That you're saving about $150 million of debt or cash each year, so that will help on the margin. What's really going to be more important is they get a couple $100 million in cash from condo closings next year, assuming that they can close units that have been pre-sold, and then the asset sales, we're expecting over $500 million of asset sales. So those are probably the more important factors. Plus, if there's a recovery in the office market and you start to see your EBITDA grow, that's also a really important factor here. So on the margin, I would rank kind of a distribution cut as a lower factor. I think there's kind of more important things we're now looking for to get the balance sheet back in better shape here.
Okay, so let me ask you, Brad, is it a bigger problem, the condo situation and those not selling, or is it a bigger problem, a return to office?
I would say the key factor for the stock over the last quite frankly, the last few years has been the return to office. Their occupancy rate has been trending a little bit lower. They're at 84% occupied at September 30th. They're kind of forecasting that to be flat for the rest of the year. They were highlighting or guiding towards 90% at the start of the year. So it's been a slower than expected recovery on the occupancy side. Ultimately, that's going to drive EBITDA growth way more than the condo component. They do have a little bit of exposure. It's one project. It's 90% pre-sold. So, it's something we think about in terms of risk profile in the short term, but ultimately this is an office landlord with, most of their cash flow and operations generated from leasing office space. So ultimately we view that as the most important factor in terms of better stock price performance and ultimately a better balance sheet going forward.
Okay, you mentioned that they do have to look at making some changes moving forward. Have they already been selling assets so far? So how successful has that been?
Yeah, so far they have started that program. That's been ongoing for most of the year. It's going a little bit slow. The type of assets they're trying to sell typically are lower density office assets that could have a future kind of development intensification opportunity. That market, just given what's happening with the condo market, is a bit slow. So that is moving, I'd say, a little bit slower than expected. And generally speaking, office transactions, we've started to see a little bit of green shoots on that front, but it's been slow for the last few years. So, we'll see how successful they are on that front. Certainly we are expecting asset sales to pick up, at least in the way we forecast it next year. But so far it's been a bit slow.
What's your price target for this point? Did it change after today's announcement?
Yeah, so we upgraded from a sell to hold. So, a little bit more constructive, but there's still, as we talked about, more things that we need to see here in terms of getting more constructive on the stock. We did take down the target from 14.75 to 14. So right now, we kind of see a little bit of upside. It does trade at a discount to NAV. It trades at a lower multiple, but I think we're being pretty cautious still on our stance in terms of the amount of time and the pace of recovery, let's say, on the office side. I think it's going to be a pretty gradual process here, and there's a lot of factors, as we talked about, that need to be executed before we probably get more constructive on Allied.
All right, Brad Sturges is with Raymond James. Brad, thanks for joining us today.